Welcome to Odds and Ends with Rob Friesen and Dave Singh. This is another StockOdds podcast, and we're here to get ready for the week and help you get a bearing on how you can use some of the data that's in StockOdds to help you with your trades. Hi, Rob. How's everything this evening?
Not too bad. Let me kick it off with the calendar this week here. So
right.
We got nothing notable on Monday. Very light on Tuesday. So the first real thing on the horizon here, calendar-wise, is on Wednesday with consumer confidence and existing home sales. And we also have the crude inventories on Wednesday at 10:30 Eastern time. Then into Thursday, we've got personal income spending, initial claims, new home sales. So Wednesday we got the existing home sales, and then Thursday we got the new home sales, natural gas inventories, and then Michigan sentiment as well. So it's quite a bit of news that comes out, like with the personal income and spending and stuff. Initial claims all comes out around 8:30 Eastern time, so an hour before the market opens on that. And then Friday, we have the markets are closed for the entire day. Normally on the 24th, we see an early closing most years, but this is completely closed on Friday because Christmas is on Saturday. So that makes this a shortened week, also in front of a 3-day weekend. So the pressures can be increased through a shortened week, and your Thursday can act like your Friday, but it's also in front of a long weekend. Blah blah blah. We're going to be entering a time here of lower volumes. So typically every year, the Friday before we have the Christmas week, that's when things kind of culminate, because it's usually expiration. It's just everybody gets their business done, and then they sort of go into holiday mode after that. So volumes can be a lot lighter, which can enhance moves either way if we rally or if we sell off. So there's not as many opponents to the move, let's say. So just keep that in mind. And I noticed that China solar stocks are down substantially. We've got we got this reject of the Build Back Better by Senator Joe Manchin. So this whole green stock area, climate-based stuff, solar, all that infrastructure stuff, that's kind of been kicked hard. And we'll see how that plays over. But want to think about that regarding our industries and sectors. So overall, we're seeing a riskier appetite. I mean, a reduced appetite, I should say, for riskier assets. So reduced appetite. We've got some headwinds. We've got Omicron, which is, the debate is still on whether it's as bad as Delta or not. Initially, we thought not, but it's spreading. The R factor is significant, spreading very, very quickly, and so you never know how that ultimate plays out and what responses by officials are to it. So it can certainly put a damper on things, and they expect it to peak somewhere in February, probably. So that might be the end of this whole COVID thing, or there may be, the end in a sense before we go to the endemic phase, right? So that could be, what ends up playing out. So I'm going to kick it over to you for some comments on the sectors and seasonality and anything that you've noted. So take it away.
Yeah, so Friday was the third Friday of the month, options expiration, and what StockOdds was predicting was that the Russell was going to do better than the Spider, and actually, in fact, it did. So I just wanted to touch base on what was last week's odds. So the Spider was down 1.4%, but the IWM was up 0.9%. So that was a good example of the almanac helping out line up
Well,
the
can
outperformance of the Russell. Uh-huh.
can I throw something out there? Our
Yeah.
listeners should actually look at all of the ETFs that were presented in the seasonality almanac. So besides, the SPY and the Russell, go take a look at. You can just select ETFs on the first page before you go to the second page where you can compare different symbols that you type in. But on that first page, just by moving the slider, you can bring in the ETFs by volume or whatever, price, volume, that kind of stuff. But if you look at them, it was absolutely amazing. The results. So what was showcased to be down on Friday and showcased to be up on Friday was like bang on.
Mm-hmm.
Really, I mean, across the board, bang on. The ones that went up, most of them went up. The ones that were showing that we're going to be down, most of them went down. Pretty textbook. But as I've said, if you're using the seasonality almanac, there are event days that are stronger than just regular days. So I've run into some subscribers once in a while trying to do Monday, Tuesday, Wednesday, Thursday, Friday seasonality. That's a very, very light indicator compared to the third Friday of the month expiration, or the first day of the month, or the last day of the month, right? Even mid-month seasonality, right? Or the end of the month seasonality is much stronger, but just any day of the week is not going to be as strong as a specific event day like expiration. But anyway, I just wanted to point that out. That was so bang on. Those ETFs were amazing.
Yeah. So my point was, we just come off the third Friday of the month, that seasonality, and then we're still this range here. We haven't reached the last 5 days of the month or last 3 days of the month, so we still have that to look forward to come next week. So we're a little bit of a no man's land in terms of the monthly seasonality. But like for tomorrow, it's a pretty risk-off day. Futures are down, oil is down. But I wanted to look forward towards next week, right? Towards the last 5 days of the month. Which sectors might be doing better than others? And I typed in the individual ETFs like XLF and XLK to try to see if there's any differences. But what I found was XLY is expected to really outperformed the Spider. So then once I determined that, like for the final 5 days of the month, we see 0.94% for the XLY and 0.47 for the Spider. So almost twice the performance out of the consumer discretionary. So I typed in a couple symbols just to see within discretionary if there might be some interesting stocks that have a little bit of advantage in terms of odds. And Amazon was one, right? 1.74% relative to 0.47. Tesla, a big one, 2.43% relative to 0.47. Walmart, again, Target also, Costco. So all these, Disney. So these are the big consumer discretionary where they just have to spend. And those are expected to do well the last 5 days of the month. And what I also tapped into were the car dealers, like the car manufacturers. They're expected to underperform. So something like Toyota Motor, minus 0.33% relative to plus 0.47 on the Spider. And then I check General Motors. Again, that's negative performance relative to the Spider. So in terms of discretionary spending, maybe not the auto manufacturers, but some of the big box retailers where people have to spend money. And then I also tapped into this kind of leisure spending as well. MGM is expected to do pretty good. So maybe the hotels, casinos, 1.58 relative to 0.47. And then I typed in Marriott, again, almost twice the performance of the Spider. A Carnival Cruise Line, another one, twice the performance. So it seems to be this theme of people wanting to kiss the current year goodbye and guess the money you could buy and spend it paying forward, right? Get some leisure, buy some goods and services. So there is going to be this possible consumer discretionary support the last week of the month. But for the other sectors, I didn't find too much in terms of the almanac itself. But that's what I found on that one. What else do you want to talk about, Rob?
Well, so we're looking at the futures right now, and how they've performed, since they opened and so on. And we are seeing a slide across the board. So the Dow Jones futures are down 0.76% or 269 points. And there's a long way to go between where it is and, say, the last low that we had, which was December 1st and 2nd, and we turned off that, and we started to rally back and kind of came back to where we started from, but it didn't make any new highs. Ran into a little bit of resistance there. Obviously, the FOMC day was a big day. Everybody embraced that, and then the next day we sort of followed through to a new high relative to that, and then from that point we just been pulling back. And but there's a long way to go on that. The S&P has less distance to travel to that low that we also had the beginning of December, and it's down 42 S&P points now, 0.92%. We've got NASDAQ 100 is very, very close, almost right at that December low. So it's pulled back substantially. It's been weaker. It's been running weaker than the Dow or the SPY. So it's down 1.06% or 167 points. I mean, just to see the NASDAQ down, 100 points or 200 points. I mean, these are amazing numbers, right?
Yeah.
And then we have the Russell, which is down 1.88% now, down 40 points, which is huge for that. And it's getting very close to its 9-month lows. We're bottom of the range. And it's actually gone below the December 1st and 2nd low. So it's already below that. So that little spurt that we had 2 days in a row, well, we had it one day, which was we had a little spurt on December the 15th for the Russell, right? And then December 16th, we hit we popped higher than that and then reversed it all. Crazy reversal, gave it all back. The next day we pop again on the 17th, right? So it's been kind of crazy, but the general theme here is it's still drifting lower, and we'll have to see what happens when it returns again to that bottom of the range. If that breaks, I mean, this is uncanny for the Russell for this time of year to be showing such poor performance, right? Like you said, you nailed it on Friday. Like it said it was going to be stronger than a SPY, and it was. But already the futures now are down more than the others, and it's not looking so good. So if you combine that with this reduced appetite for riskier assets, I mean, we are clearly seeing the market indicating that. The Nikkei is off, the Euroland is dropping, and the VIX is rising back. We're at 22.8 on the VIX now, up 8.22% right at the moment on the VIX futures. So, this is what's playing out again. So I think, the Build Back Better, and sort of that block by Manchin there, I think that's part of it. And then, of course, the Omicron is part of it. And still, we've got this supply chain, inflation overhang. I think the market's just, we just got to get through this this is all part of this little bit of a taper tantrum. It's all part of, concerns and stuff like that. And, we can't get into the roaring 20s if that's going to happen until we get and shake some of this stuff off. And the taper, has to get munched on and done by March, I guess. So it's going to be interesting. I would never argue with the market that it can't, it can't rally, but right now it's it's not looking too good at the moment.
Yeah. I was looking at the 52-week highs, like for the IWM, we're 12% below the 52-week high, but on the spider, we're only down 2.89%. So as bad as it feels, the spider is holding up pretty well. And then the NASDAQ, the QQQ is down about 6%. So it's minus 3% for the spider, minus 6 for the QQQ, and minus 12% for the IWM. So, the small caps are taking it on the chin relative to the others.
Yeah, but I really like, kind of getting a picture of some of the groups, and just like Friday, where you came in the morning. Well, you had the data before. You already had the odds for the main ETFs and the other sort of leading in ETFs. You had the odds for TLT, you had the odds for XLF before Friday even started. Then you come in Friday, there it is, laid out on a platter for you, just as you would want it. And so it's so easy to take that information and make your slight adjustments for the day. I'm still a believer that if I see a macro, if I can observe something, not make it up, but actually it's staring me in the face, that I can say, hey, I don't need to buy any financial stocks long today. I don't need to include that. I'll just include the shorts. I don't need to include the longs. So it's easy to take that out if you have real information and conviction. But if you don't make it up, right? Stay diversified, stay in a posture that takes that discretion out of it. But if you have information that's clearly staring you in the face, you can certainly make some adjustments. That's what we'll be looking at tomorrow as we come in. It's probably at this point going to lean more to defensive. We did have a bit of a lapse on that for a couple days since the FOMC. We had even a slightly prior to it, but we had a little bit of a return to going after some of these tech names and some of the Russell stuff, and I think we're flipped back now to the Dow Jones probably outperforming the S&P, the NASDAQ, and the Russell. So that's the way I'm going to be leaning for tomorrow, is more emphasis on the Dow Jones names and the more credible defensive stocks. That's my posture going into tomorrow.
Sounds good.
Okay.
All right. Well, good luck.
All right. Well, good trading, and nice chatting with you again. And let's knock it out of the park. We got 4 days to do it.
All right. Thanks.
All right. Take care.
Thanks. Bye-bye.